welcome to the second panel, and we will go straight into our race. The individuals who are sitting side by side are all members of the EPG. I want you to know that none of us has invented that name. Somebody else decided that the name would be Eminent Persons Group. I'm privileged to moderate this discussion among our friends. And the subject, this panel, is about the financial side. How can we make sure that countries all over the world make the best use and are able to absorb and have the benefits from international interconnectedness in the field of finance? One of the reasons is that with the increased degree of interconnectedness, capital flows occasionally have carried with them risks and volatility. And the question is, what do you need to do in order to have the cake and eat it? There is a Chinese proverb that was presented to the IIF more than a decade ago by Lu Mingkang, who at the time was the head supervisor of the Chinese banks. And the proverb says that the honey is sweet, but the bee stings. And the issue is, how can you benefit from the honey without being stung by the bee? And that's a major agenda, because when the Bretton Woods organizations and the international financial system and the multilateral organizations were designed in the early days, the main interaction among countries was in the form of trade in goods. Financial services were secondary in a fundamental sense. And yet, that's the major new development. How can we enjoy the honey without being stung? And this is the agenda for this particular panel. We have here, and I'll just describe very quickly, our good friends, Mr. Takatoshi Ito. All of them have had significant public sector career, and they moved on. But the important thing is, and that's what characterizes the Eminent Persons Group, people who have made their career are very much interested in, involved, and gained reputation in public policy as they went on to their own activities. So Professor Ito is now Professor of International and Public Affairs at Columbia University, former Vice Minister in Japan. We have Fabrizio Saccomanni, who is currently Chairman of the Board of Directors of UniCredit, former Minister of the Economy of Italy, and of course, the former Director General of the Banca d'Italia. We have with us John Taylor, who is now the Mary and Robert Raymond Professor of Economics at Stanford University, and George Shultz, Senior Fellow at the Stanford University Hoover, and a former Undersecretary of Treasury of the United States. We have with us Andres Velasco, who is currently the Dean of the School of Public Policy at the London School of Economics and Political Science, former Sumitomo Professor of International Finance at Harvard Kennedy School, and former Minister for Finance for Chile. So as you can see, that's the typical profile of the group. All of them care for the key issues, and I will move. We divided the responsibilities among us. So I'm going to be the traffic officer. That's my contribution. And we will have each one of them cover a couple of topics. The first issue is the issue of capital flows And there we will have contributions by John Taylor and by our good friend Ito. There is always the question of what is the recipe for successful performance of an economy. And there are a lot of approaches. And we don't have great convergence even among the professionals. It was important, therefore, for us to identify the compass and agree where is this train going to end up, call it the long run. Once we agree on the long run characteristics, the rest in a way is much more adjustable. Each country will reach its long-term goal in its own way, in its own pace, depending on circumstances. But there is something that unifies this globe, the agreement about the compass, about the long run. And in this particular context, we focus on long-run integration of capital markets. But we need to do a lot of things along the way. Let's start with John Taylor, please.
Yeah, thank you. Thank you, Jacob. Thanks for coming. This is an issue which involves the financial sector. And our stated goal, as Thorman indicated at the beginning, is that investment will provide for better development, for increased productivity, for increased growth around the world. Recently, there's been concerns about investment being volatile and exchange rates being volatile. And one's position on this tends to be depending on where one sits. We found it in traveling around the world in this group. Some think the issue is more what's going on in the developed countries, so push factors, if you like. Others think it's more what's going on in emerging market countries. So to deal with this, we think it's important to have what we say in the report, a rules-based international framework through which policy advice can be given by the international financial institutions and the IMF. This framework has to involve something that improves the resilience of markets, as Jacob has already mentioned, something that deals with spillovers, which seem to be apparent, and something that enables countries that need these funds, need these investments, to benefit them, at the same time having the savers be rewarded. So based on this, we have, of the 22 proposals, several proposals in this area. And the number one is to have the international financial institutions, with the help of the private sector, obviously, provide more resilient markets around the world, more markets that can handle flows of capital in a way like developed countries frequently can. Second, which is very important, Jacob referred to this, is to have a long-run goal of openness to capital flows and capital markets, a long-run goal. We're not there yet, obviously, and there's things that need to be done before we get there, but holding that out as a goal is very important. It's different. It's a different idea that has been discussed recently. To some extent, then, openness on the capital markets, we hope, will flow intellectually and practically to openness in all markets, openness in trade markets, trade of goods and services, which we're so concerned about. Now, as part of that recommendation on openness, we think it's very important for countries, sometimes called sending countries, whatever the word is you use, to find ways to improve their economies that minimizes spillovers around the world. Find policies which work to provide better economic performance, greater productivity, better growth without the spillover, at least to minimize the spillovers. And the other part of this proposal, which is important, applies more to emerging markets. And that is for them to find ways, as they reform, as they improve, as they follow the best examples out there, to benefit as much as possible from this investment, which is so important for productivity and improved well-being around the world. Thank you.
Thank you very much, John. We will return to many of these issues in the discussion, and we proceed with Professor Takatoshi Ito, please.
Thank you. So last year and this year, we have had many conferences on the 20th anniversary of the Asian currency crisis and 10th anniversary of the global financial crisis. So financial crisis seems to strike us every 10 years, but we haven't had it this year, so that's good. But why the crisis happens, and we are learning all the lessons. And I think one lesson we derive from the Asian currency crisis, since we are in Indonesia, is that the sequencing is important. Although we are, even if we agree, and I hope we agree on the long run goal, that more connected financial markets is good, and open capital flows is good, even though we agree on those long-term goals, the how to get there, the sequencing is very important. And relying, and also Taman mentions that current account is good, and if you're financed by the foreign capital inflows, but what kind of inflows? FDI, we think is very good. Bond finance may be good if it's long-term bond, and the equity inflows, that's good. But short-term capital flows, especially those bank credit, may not be so good. That's the sort of the liquidity crisis, origin of the liquidity crisis, and how to deal with it. Andres will propose something that we agreed in our report shortly. But what's the point is, I think you have to keep your domestic markets developed and make it deep and liquid and resilient. And to do that, what kind of capital inflows you accept seems to be very important. That's one lesson we had from 20 years ago in this region. The resilience, the deep markets domestically, and keep your domestic macro good. That's the first thing you have to do. But then you need you work with those foreign capital, and for emerging market, that's the source of the development and fast growth. So the combination of those resilience in domestic markets and openness to foreign capital, but with sequencing. That's the one important lesson from the Asian currency crisis. And we, in our report, we emphasize those balance between the domestic markets and financial market connectedness, and that's the important part of our recommendations.
Thank you very much, Professor Ito. So now we believe we touched on, and we may even know, how do you make your economies more resilient? However, crises will occur. And when they occur at a time that you are not always expecting them. There is a quote in the study that says, "We will not know where the next crisis will start, but it will become a full-blown crisis when broader global with broader global consequences when we are not prepared for it." But we need to be prepared for it. What kind of information we should gather? How can we integrate the work of various multilateral organizations to help us in the surveillance, getting ready information task. And for this, I would like to address Mr. Fabrizio Saccomanni, please.
Well, thank you very much. I think both Professor Ito and yourselves have pointed out to the lessons of the global financial crisis, and I think the issue of sort of giving a contribution in our report to make sure that the next crisis does not find us unprepared and that its consequences may be mitigated has been, I think, a factor of our discussion throughout the 18 months in which we've been working on this report. The reason is that it is true that the global financial crisis was not really foreseen, neither by the international financial institution nor by professional, academic, or business economists, as was pointed out famously by Queen Elizabeth II at the London School of Economics. Why, if it was so big, no one was able to foresee it? Well, in my feeling, and I think in the feeling also of the discussion, the reason was that probably at that time, we misunderstood the degree of interconnectivity of reach of financial markets. And I think the fact that, contrary to what had happened 20 years ago, this time the crisis was originating in the core countries of the system, in the United States, the United Kingdom, and then the European Union. I think it gives an indication of sort of the true nature of financial crisis and the new type of challenges that we are confronted with. And I think since the crisis, I think the emphasis of the international community has been primarily on strengthening the regulatory framework. And even in the many papers that have been written to celebrate the 10th anniversary of the global financial crisis, the recurring theme is that finance has been strengthened but not quite fixed, in the sense that, of course, a lot has been done to strengthen the capital base, the liquidity instruments, and also the reducing the non-performing exposures and so forth. But, the global origins, the global factors of crisis are not really under control. So that's why we in the EPG thought that we should sort of give a strong warning that a lot of efforts needs to be done to make sure that all the resources, analytical, professional resources available within the framework of international financial institutions can be put to a joint effort of monitoring what we call the risk map. And that, of course, includes a lot of new risks, because, financial institutions tend to look at credit risk, at market risk. But now you have a lot of other risks that have to be taken into account because they can have broad repercussions, as we have indicated in the report. So I think the call to the IMF, who has been developing over the years a remarkable sort of expertise in looking at global current account imbalances and at policy spillovers and these kind of issues, but also from the Financial Stability Board, which has again been in charge not only of strengthening the regulatory system, but also in identifying what are the sort of the vulnerabilities still implicit in the current regulatory system, particularly as regards the so-called shadow banking system, which is probably also shadow non-banking system, but what is relevant is the sort of lack of full transparency and then, of course, the role of the BIS, who is representing, the world, the most important central banks, who has developed important expertise in analyzing the so-called financial cycle in many countries, particularly in industrial countries, and in sort of trying to detect what are the origins and the root causes of a financial crisis that may have gone beyond the sustainability level and therefore bound to create situations of uncertainty and potentially of crisis. And I think we have to be prepared, to look at in this risk map, global risk map. We have to look at the probability of a sudden change in the risk appetite of major financial investors, because that can be the source of major changes in the attitude of investors. And I think then it can lead to sudden deleveraging. I think there is now greater attention, and it was pointed out in our report, in the evolution of the global indebtedness, although I see with some concern that practically every institution comes up with a different number for the global debt, which points to the fact that we need to do a little more effort to understanding what... and then, of course, we have to understand better what could be the impact of liquidity shocks on the infrastructure of financial markets, the payment system, the operation of counterparties, central counterparties in dealing with derivatives and so forth. We need to look at the impact of technological changes, the problem of cyber attacks, but also the role of fintech and big techs, I mean, the companies like, Amazon, Alibaba, Google, and so forth, who are now entering the field of financial services without actually being regulated. So, to sum up, I think, there is a lot of effort needed to understand what is the sort of the nature of the risk that the financial system is confronted with, and I think we hope that the call on these three crucial institutions is accepted, and that of course they have to maintain their own independence, but I think they'll have to flag independently the risks as they see them, rather than trying to reach a sort of a consensus by watering down differences. And they should be able to give full representation to minority views or contrarian views, which was not the case, for example, in 2008, 2009, when certain views expressed by the BIS were not really taken into account seriously. So I think, and then the crucial point, which I think has a policy relevance, is that the results of this mapping of the risk should become an integral part of the efforts of the IMF to sort of conduct these early warning exercises on crisis risks that I think will be a crucial aspect of the new governance. So I think that is something I strongly believe it's a major contribution coming from this report, mapping the global risk. Thank you.
Thank you very much, Fabrizio. And we are moving now to the next subject. Several of you have reminded us that crises have occurred in the past, and that we even have some anniversaries as we care to remember them. But we note that in several occasions, what started with a liquidity challenge, which was not addressed properly, transformed itself into a solvency challenge. And how simple it would have been if a liquidity challenge was solved by liquidity instruments and not getting into the territory of solvency and everything else that follows. There is always, when IMF and other organizations come to countries encouraging them to do the right policies, a lot of risks are entailed, and policymakers are not always eager to take that risk. And how simpler it would have been for them to know that if they slip, it will not be a disaster because there is somewhere a safety net. I was told by those who go to circus that the acrobats are performing much better when they know that there is a safety net. Even if it is not used, the very knowledge helps to trigger better performance. So there is nobody better to tell us about these aspects than Professor Andres Velasco, former minister from Chile, about the design, the role, and importance of global financial safety nets in securing all of what we wanted to achieve. Please.
Thank you, Jacob. The chairman of the EPG started out, I think it was 2 panels ago, with a point to which I'd like to return. And the point is this. In order to grow the world economy, and countries in particular have to invest. Some of this investment, of course, has to be financed domestically, and one of the points we make in the report is that we have to strengthen domestic capital markets. But just as naturally, some of this financing should come from abroad. And in fact, what we teach students, I'm a professor of international finance, it is that it is optimal for a country that is relatively poor today and which will be richer tomorrow to borrow from the future, access the capital markets, and repay later on when it is rich. And as Tarman pointed out, very successful countries, sort of miracle countries of the last 20, 30, or 40 years, the Koreas or the Singapores of the world, borrowed heavily or got large flows of capital from the international economy. This allowed them to invest and to grow. And then in the transition, they had current account deficits. Well, today that is very hard to do. It is very hard even for a well-behaved country with all the right policies to follow a path of sustained current account deficits, high investment, high growth. Why is that? For one simple reason. The flows of capital that are necessary to make this happen tend not to be as stable or as reliable as we would need them to be. And countries know this. And because countries know that being caught on the wrong side of a liquidity squeeze is very dangerous, well, they act like Jacob's acrobats. Maybe they don't do the right things, they don't swing from the right ropes, and as a result, they grow less. What are the 3 possible outcomes in a world of international volatile and unreliable capital markets in the absence of a good safety net? Outcome number 1 is you're a conservative country, you say, well, I don't want to get into trouble. As a result, I don't run current account deficits. Will you have a crisis? Well, maybe, maybe not. However, you will not be investing optimally, you will not be growing optimally, your population will not get the welfare gains it needs and deserves. Outcome 2 is that you choose to run current account deficits, but along the way you build up a large stock of reserves. And to get reserves, of course, at some point you have to run a surplus. So in a way, outcome 1 and outcome 2 are very much the same. We call this self-insurance. And if you look around the world today, many countries, mostly in Asia, but not only in Asia, some in Latin America, some in Eastern Europe, are sitting on very large stocks of reserves. This is good from the point of view of safety. It makes markets calm. But if you think about it, it is a very inefficient and very expensive way of insuring. You know, if I buy a house and I expect that there's some chance my house might burn down, I don't sit on a pile of cash to buy a new house in case my house burns down. I buy an insurance policy and I pool the risk of fire with other homeowners in my city, in my state, in my country. Regrettably, today in the world, we don't have enough risk sharing of the kind we have in domestic markets. Outcome number 3 is that you say, I'm going to run a deficit. Then you say, I'm not going to self-insure, it is too expensive, and I'm going to leave myself open to circumstances. Well, that's very well for a while. But what we know, and Jacob said it very well, is that sooner or later a crisis will come. And if you look at the last 25, 30 years, one of the amazing regularities in the world economy is that we get a major crisis every 5 years. Once upon a time, we used to get them only in emerging middle-income countries, but of course, a decade ago exactly, we had a crisis that went far beyond the confines of the typical middle-sized, middle-income countries. It engulfed the US, the UK, much of Europe, much of Asia, etc., etc. Some of these crises have fundamental causes. Yes, countries do misbehave, but many of these crises have causes that are not fundamental in the sense that they were caused by some wrong policy at home. They're simply liquidity crises. You're going along that path, you need to keep borrowing, you're cut off from the world capital market, you get a reversal of capital flows. Not only do you get capital no longer coming in, suddenly you have to repay, and the contraction, the crisis, the liquidity crunch, the liquidation of what would otherwise be good assets, all of that is painful, it is inefficient, and we want to stay away from that. Bottom line then, we need a global safety net, a global financial safety net. And what we have today is the makings of one. We have bits of pieces of one, but we don't have a global, coordinated, well-functioning safety net, both for rich countries and for poor countries. Of course, when the last crisis came about a decade ago, the world did step forward and the major countries did take the lead. And as a result, what had been a safety net that relied mostly on the IMF accounted for about 90% of resources, became a network or a safety net which now has the IMF. But today the IMF, according to the numbers we have in the report, only accounts for about a third of total resources. And 2 new modalities arose. One is, of course, regional financial arrangements, which are great, but they're not uniformly spread around the world. They're concentrated in a few areas, Europe being the prime example. And currency swap arrangements among central banks, which again are a great thing if you're lucky enough to get one. And of course, some countries, most of them, not all, systemically important, have access to those swap arrangements. Many countries do not. So the main message from our report is that we have a safety net that is evolving, but which is way too patchy, which is unevenly spread around the world, and where coordination among the several components of the safety net is not as good, not as swift, not as reliable as it should be. 3 quick proposals to follow up on this. Proposal number 1, we need coordination. And of course, coordination is one of those words we always reach out for. In this case, it happens to be important. For instance, one example of that coordination could be that if you're a country that hopes to have access to a regional financial arrangement, how do you qualify for that? Well, you pre-qualify by having pre-qualified for an IMF credit line. So one admissions procedure, if you wish, more than one credit line available, that makes coordination, rapidity, easy access much more likely. Idea number 2, we need a larger standing liquidity facility located at the IMF. It is great that other arrangements have arisen, but having the fund account for only about 30% of total available resources is certainly not enough. And I think you may have different views, but it is hard to read history, at least in my view, without understanding that many countries, in fact, moved from liquidity to solvency problem, as Jacob said, because they did not have access to sufficient flows of liquidity in a timely fashion. So we want a larger, more reliable, quicker dispersing liquidity facility at the IMF. And for those of you who are thinking, well, this is going to provoke bad behavior, moral hazard, the answer is no. Yes, we want pre-qualification. This would be available to countries that have demonstrated ex ante that they have the right kinds of policies. Last but not least, the IMF is going to be needing more resources for this. And this is simply not a conjecture. If you look at what happened a decade ago, special temporary arrangements were made, one for $500 billion, one for $450 billion. That is the kind of firepower you need for fighting, especially the large, systemically important tail risk events of liquidity. The fund has nowhere that kind of money today. Understanding that getting more money to the fund is a tricky subject, and understanding there are many ways of going about this, the report does not take the stance of saying we have the recipe, the formula. We outline in an appendix 3 or 4 alternative ways. We think this is a matter that needs further discussion. But that menu, if you wish, does not take away from our major point. The major point is we are going to need more money. We are going to need a larger liquidity facility from the IMF. And we certainly are going to need more coordination across the different components of the safety net. Unless we develop those 3 elements, and unless we develop them quickly, we're likely to go bumping from crisis to crisis, from liquidity squeeze to liquidity squeeze, as we have, regrettably, for the past quarter century. Thank you.
Thank you. Thank you very much. What is unique about this entire exercise in the report is that it is not just a document. It's a concept. It's a concept that recognizes that the world is full of reports that have been shelved and put on the shelf. And our first question before we started was, how do we make sure that it is not just another one of those? And it became clear that it requires a very complex network of interactions within the private sector, interactions among the private sector, interactions with the public, with the media, with the international organizations and the like. Otherwise, it will be just another report. And that's the reason why the scope has been so wide. All the 16 members of the group, as I mentioned to you, are people who have had record in the public sector, but they have only one agenda: to improve the performance of public policy. We are chaired by, and allow me, Sarman, to say something which you did not give me permission. We are chaired by the most dedicated, skillful chairman, Sarman, who is the Deputy Prime Minister of Singapore. And the reason why it is so essential is that his relations with the various authorities, this report has to be owned by each and every stakeholder, each and every player, because it's very difficult to succeed otherwise. The scope of the report is therefore very wide. We are talking about growth and development, but for this to be successful, it has to be inclusive growth, inclusive development. But for this, we need to go into the territory of sustainability. Sustainability includes education, health, environment, climate, all of those things that typically are not mentioned in this room of the IIF, but the system will not succeed unless we address them. And it's essential that we really address them. It's not a financial issue per se, but it is a sine qua non. So the combination of macro, finance, development is an integral part of it, including the interaction among the institutions, IMF, World Bank, multilateral, BIS, FSB, all the anachronisms that are familiar, but they have a lot of people, a lot of concepts that need to be bridged. And we made significant effort in this direction, but it requires, therefore, mobilization of the intellectual resources, including those in this room. Let me open the floor for either discussion or anyone on the podium here that want. The internet here is not so superb, so the idea of having an iPad that I will receive all the questions is a good theory and a good idea for next time. So, therefore, just raise your hand. We will not succeed in the report if we are surrounded by bashful people. So just step in, we have an agenda. Please, raise your hand. Questions, suggestions, doubts, encouragement. Any more? Okay, the first one is tough. Let's start from the second.
Down there.
I can see the second. Please, raise your hand. Can you identify yourself? Are there microphones around the room? Okay, use your voice. I can see your hand. Is there a microphone? Can you raise your hand so the microphone can get to you? Please identify yourself. Okay, I see that there are two individuals. Go back, please, behind you there was a number one. Okay. In the darkness I cannot see anything. Come on, let's move.
Yes.
Yes, please. Excuse me, the person who takes the microphone immediately after him, please go to that corner. Go ahead, please.
This is Richard Koo from Nomura Research.
I'm sorry, a little bit louder and identify.
My name is Richard Koo from Nomura Research. I was involved in the Latin American debt crisis cleanup as an economist at the New York Fed. And I remember from that horrible experience that one of the key reasons why crises do happen is because of the greed of the creditors, not of the borrowers. And I think it was one of the persons from Chile who said the key lessons from that Latin American debt crisis is not to take all the money that is offered if the creditor hasn't done any homework on the borrower. Now, your report addressing the issue of how to keep those uninformed, ignorant creditors from throwing money at your country. Thank you.
Our report recognizes that there are a lot of institutions and divisions of responsibilities for a variety of areas. In particular, the bank supervisors are in place, the bank regulators are in place, the financial literacy is in place, and each one of them has a father and a mother that needs to be promoting them. So yes, our report did not address them specifically. By the way, I'm not sure that I fully accept, by the way, the notion that there is always a blame on one side. When a picture falls from the wall, it is a blame of the nail, it is the blame of the wall, it is the blame of those who hanged the picture, it is something did not go well, but the important thing is, I don't think it will be very useful to say, let's find the one to blame, but rather let's strengthen the system so that pictures do not fall from walls. You had a question. Microphone, please.
Good day. Thank you. My name is Mark Brits, and I'm from South Africa. I just wanted to find out in your report, which unfortunately I have not read yet, do you make any mention of local market? Hello?
Microphone doesn't work well.
Can you make any mention of local market conditions because there's a presumption that markets need to be deep and liquid. Have a look at Malawi. They issued a government bond on their stock exchange, which matured with nobody actually purchasing it. In Lesotho, they were advised to establish a stock exchange, which after 3 to 4 years has not listed a bond yet, has not listed a stock. Do you recognize that not all markets are equal, and you have to actually, hello? You there? Okay. You have to actually match your debt requirements with the actual economy that you're approaching.
There is a combination of the toughness of the question and the difficulties of the listening. Because normally my colleagues in the choir or in the orchestra are jumping at questions. Why don't you imagine what the question would have been and answer?
Actually, I was tempted to say something about the prior question, given that it alluded to Chile, and while I do that, maybe we will come up with a version of question number 2.
And the only thing is technological progress.
Yes.
The one who has a microphone, please hold 2 of them as you go to the next person, please.
No, I think the prior question makes a point that I half believe. Yes, it is true that sometimes if you are a developing country, the capital markets come knocking on your door and offer you money when you don't need it. You know, it's the old joke about the umbrella, you know. You get the umbrella when it's not raining, and you can't find an umbrella when it is raining. However, it is also true that even if you're a well-behaved country that refuses to take all that money when you don't need it, some moments arise when the crisis is so large that even if a well-behaved country gets into liquidity troubles. I was the guy in charge of international borrowings for the Republic of Chile in the early 90s. That was my first job. And when my boss gave me the job, I said, "What are my marching orders?" And he said, "Say no." You know, people came knocking on our door. They said, you know, here's some nice capital, and my orders were to say no. As a result, when the big financial crash came in 2008, Chile had 3% of GDP in public debt, 3% of GDP. We had something like 25% of GDP in cash reserves, and we had a balanced current account. You would have thought, under those conditions, you would never get cut off from capital markets. Wrong. Even a country with those macro fundamentals, we got entirely and total cut off from capital markets. So I guess the underlying theme here is that liquidity events happen, and liquidity events happen to countries that have the right fundamentals. As a result, to prevent those countries from undergoing unnecessary pain, which may spill over across borders and across regions, you need a stronger facility. You need a stronger safety net, and that's what we propose.
Thank you. I can see here a hand, 3rd row. Please.
Samir Hamoud from Lebanon. I really was somehow admired the 3 alternatives you have put us before for the crisis and the liquidity crisis. You said that the second one, that you will be going into and continuing to be into the balance of payment and the current account deficit. However, you have to build up more reserves. Mm-hmm. This is not clear to us. How could it be that you continue to be in the current account deficit and you continue to build at the same time good reserves? Mm-hmm. The second is that it is not only necessary for the IMF to have more resources for the liquidity somehow solution, it's that you have to have the criteria for providing for such liquidity resolutions. Mm. Thank you.
No, you're absolutely right. Clearly, one cannot run a deficit all the time and accumulate reserves. It's a matter of accounting, at least not gross reserves, not net reserves. You could run gross, accumulate gross reserves by borrowing and putting the money in the bank. And some countries do that because they may lose access to credit when a crunch comes. But you're absolutely right. the strategy, what I call strategy 1, run a current account that is balanced, and what I call strategy 2, accumulate a lot of reserves, are really two sides of the same coin. And they're both inefficient for the same reason. That is to say, they force the country to forego profitable and welfare-enhancing investment opportunities. Precisely because those two arrangements are inefficient, we need a stronger access to liquidity when the crunch comes. And that stronger access to liquidity must be guaranteed from the system itself, hence the need for the global safety net.
Thank you. I see two more. I'll start with Ngozi and go then to you. We have our colleague from the EPG, Ngozi, former Minister of Finance of Nigeria. Please.
Thank you, Jacob. I just didn't want the comment on the countries like Lesotho and Malawi going to the capital markets to go unanswered. Because I agree, I don't know where the gentleman who posed the question, but our report does touch on that in a way. If you remember when I spoke about the issue of us supporting countries through country platforms that look at core standards. And one of the standards we talked about was debt sustainability. So we would definitely not be in support of countries that do not have the depth and breadth to have the kind of capital market that you talked about, or to float a government bond that they could not sustainably service, to go in and do that. That's very clear. So yes, from that perspective, we would be with you in your comment. Thank you.
Thank you very much. Here, please, third row. Please.
Thank you. Thank you. Gabriel Casillas from Banorte Bank in Mexico. I'm a big admirer of all of you, and I think the report's very good and the proposals. But I'm very concerned because then if the IMF stuff is right, and we're going to have some deceleration or recession in the next 18 to 24 months, then the IMF should gather resources and give a lot of flexible credit lines and pre-qualifications. I mean, those I think are very bright ideas, but I'm very concerned that this will not come at the right time. So what, in your view, could happen if the IMF is not prepared for this, and if, I don't know if the US will be like stepping up, trying to provide liquidity? Thanks.
Mr. Taylor, I think that's for you.
So let me answer the question in a very broad sense. There's been reactions to the kind of capital flow issues that Andres has been referring to, which is more restrictive on capital. Sometimes restriction going in, sometimes restriction going out, sometimes the threat of it not getting your money out. Seems to me those are all detriments to the goal of having more investment for development. They are an impediment for markets operating in a good way. So what we're trying to do is find ways to avoid those, to focus more on making the markets more resilient so countries can benefit from them, and also making sure that we see the sources of the volatility, which some people are pointing to, not to the emerging markets, but to other developed countries. So bringing those all together, the hope is there will be more investment, which is so sorely needed around the world. And it is a problem because the volatility is leading to restrictions, which I don't think are the best way to go. Maybe that's the only way to go right now. But to move away from those to a more resilient capital market, like many countries have benefited from, is what we're trying to do here. And there's different debates about how to do it, whether the safety net should be big, who should have access to it. But the goal is more investment for development, for growth, productivity.
Thank you, John. Fabrizio, one footnote.
I mean, one of the consequences of the crisis has been, as pointed out by Andres, the accumulation of reserves, but also, I think, a certain degree of financial fragmentation in the global financial system, the introduction of capital restrictions, the introduction of measures of a macroprudential nature. I think, if you look at the complex of these measures, the result is indeed less than optimal. And I think the report, I think, tends to sort of promote some sort of capital flow management, a new style, or a 2.0, or whatever, which looks in a more integrated way at these developments, and from the point of view of the sending countries, the push factors, the receiving countries, in order to find a way to have some sort of a capital flow management approach that does not create additional fragmentation and restrictions.
Thank you. Last footnote by Ito.
So when all the depositors come to a bank at the same time, then banks cannot pay. So that's why there is a lender of last resort, the central bank. And so it could happen if the herd behavior is causing those liquidity problems. That's why we are serious about thinking how to build this safety net in a global sense. And we have some tension between Asia and IMF for the last 20 years, and we haven't resolved it yet. And so we have some proposal that we may be able to overcome this IMF stigma, so-called. And in the meantime, Asian countries are piling up the foreign reserves. And so there is a tension that we have to solve, and we have some proposal that we can get over it, but we have to see whether it works.
Thank you very much. Ladies and gentlemen, our time is up, even though the agenda is still ahead of us. The report, as you can see, may sound very ambitious and may actually deter people to say, well, it's so big, I'm not going to be able to do it. So we concluded, in fact, the report with a very optimistic view. And the last sentence is, some of the reforms are low-hanging fruit. Most are achievable within a few years with focused effort. Some others go beyond current thinking. We urge that they be considered with an open mind and developed further or adapted, if necessary, to enable their implementation. The ambition is in the doing. So that's the report. I would like to thank you very much for your presence and attention. Let me thank our panelists, and let me repeat again the deep, deep thanks and appreciation to our chairman, Tharman, the Deputy Prime Minister of Singapore, who has done with his staff an unbelievable job. Thank you so much.